Trump's oil ambitions clash with industry realities. President Trump aims to tap into America's oil reserves to boost the economy during his term. However, industry shareholders prioritize dividends over his political agenda. Moreover, oil exploration and production economics are complex and unlikely to be influenced by short-term political policies. Donald Trump has plans to revitalize the U.S. economy by drilling deep, literally. During his inauguration speech, he declared, "We have something that no other manufacturing nation will ever have, the largest amount of oil and gas of any country on earth, and we are going to use it. We will be a rich nation again, and it is that liquid gold under our feet that will help to do it." However, according to experts and research, the claim that the U.S. possesses the world's largest oil and gas reserves is not entirely accurate. Furthermore, the president cannot unilaterally decide to extract these resources. Unless Trump plans to drastically overhaul the nation's energy sector, the decision to ramp up drilling is not his to make. In reality, it lies with private industry shareholders, who will only approve increased production if it makes economic sense. When Trump speaks about America's natural resource amount, he may be referring to production levels. In this regard, he is correct. The U.S. has led global oil and gas production for most of the past decade. However, the industry is preparing for a plateau in production growth as reserves are depleted and new drilling opportunities dwindle. After years of aggressive investment in technologies like fracking, the focus has shifted toward returning value to shareholders and conserving resources for the future. Shareholders are unlikely to abandon their financial priorities out of patriotism alone, says Matthew Bernstein, a senior analyst at Rystad Energy. The sentiment in the industry is largely apolitical, Bernstein told Fortune. When budgets are released, companies will stick with their corporate strategies, prioritizing shareholder returns, moderate growth, and capital discipline. He added, "Companies may appreciate having a pro-oil and gas administration in the White House, but it won't significantly change their long-term plans." There is a slight possibility that a business-friendly administration could accelerate capital expenditures originally planned for the 2030s, moving them up within the next 5 years. The opportunity could be to bring forward some future production planned for the 2030s and 40s, said Robert Clark, vice president of upstream research at energy analytics firm WoodMac. However, he cautioned against expecting dramatic production increases. Would it be enough for the U.S. to return to growing by 1 million barrels per day annually? That's unlikely, but some level of growth is still possible, Clark said. The real question is whether policies or incentives could shift investments originally projected for the 2030s into the latter half of the 2020s. In the long term, other nations may discover reserves surpassing those of the U.S. As of January 1, 2024, Rystad Energy estimates that the U.S. has proven oil reserves, 32 billion barrels, proven and probable reserves, 44 billion barrels, total potential production, 156 billion barrels, Saudi Arabia, 106 billion barrels, proven, 177 billion, proven and probable, 247 billion, total potential. Russia, 58 billion barrels, proven, 93 billion, proven and probable, 143 billion, total potential. While the U.S. leads in production, its long-term dominance in oil reserves is uncertain. Without significant new discoveries, other nations may eventually surpass its potential.